Welcome back, everyone. Michael here with Offshore Citizen. If you have not been doing any traveling, you may not be aware of the fact that the US dollar has been going nuts. It is at 20-year highs. If you look at the DXY, which is a general dollar index, it has reached almost parity with the euro. And so I've had some clients asking me the subject of should they be buying euros now rather than dollars? So we're going to talk today about currencies. I'm going to talk a little bit about the mental model around how currencies perform and therefore what that should tell you. And in the meantime, we're going to figure out whether you should be taking this opportunity to flip more into euros or dollars or what you should be holding. So let's dive in. Before we do, if you haven't already, please smash the subscribe button, hit the all notifications bell, little bell there. Make sure you don't miss out on any of our future videos. If you like the video, give it a thumbs up. And if you would like assistance with all the things we talk about here on the channel, which are relocating abroad, getting other passports, residencies, citizenships, paying the lowest legal amount of tax possible, we help you to figure out what is the best solution for you and implement that solution. And so you can reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or you can send a message through our websites, offshorecitizen.net and offshorecapitalist.com. Okay, so let's talk about currencies. Now, I will say, in all full disclosure, currencies are not my area of expertise. I find it quite difficult to call the moves in, I would say, the long term and the short term. So I'm looking at more medium term. I think short term, you'd look more at technicals to figure out what's going to happen in the very immediate. So I'm talking about over the next little while, meaning that what I say here now, I wouldn't necessarily expect to be true in the next 2 weeks or something like that, but just be a general guideline. And so as I have kind of looked at the world and looked at currencies, I understood nothing at all about currencies for a long, long time. And it started to kind of become apparent exactly what the deal is with currencies, which of course is that it's just supply and demand, right? So one of the good examples of this was in March 2020 when they were shutting down the whole world and the stock market was taking this dive and the US dollar went way up. What happened there? Well, a few things happened, right? First of all, people are fleeing out of other assets into the dollar as a kind of flight to safety mechanism. And then one of the things that was also happening was companies were basically cashing up to be able to cover their debt obligations in dollars. Okay, so we had that little move. Now, I have to kind of think about how it works with currencies and currency stability in general, which is they're based on the things that you're going to buy in that currency. So this is something that people tend not to understand. I hear a lot of kind of false information when it comes to something like, say, the volatility of Bitcoin, right? I did a video about this back in maybe May of 2020, covering various different myths. And one of them was about the idea that volume dampens volatility. And it really isn't the main thing that dampens volatility. The main thing that dampens volatility is the exchangeability of a given asset. So the fact that certain things are priced in that asset makes a big difference. So let's just use a quick little example. Okay, so the Canadian currency tends to, especially historically, it's a little bit less now, but tends to be fairly correlated to the price of oil. Okay, when the price of oil does well, the Canadian dollar does well. Why is that? Well, because the Canadian dollar is the currency used to pay for kind of a lot of the stuff that takes place in the oil field in what is the largest industry really in Canada. So a very huge share of Canadian GDP traditionally comes from the oil industry. And so when there's a lot of demand for oil, then there's a lot of influx of capital into Canada in order to get access to that oil, right? So that's kind of the basic idea. Now, of course, most economies are much more mixed, right? Canada is probably an example of one that is more narrow than many others, although you could expect some other very specific natural resource currencies. We see obviously the correlation with mining, with the Australian dollar, etc. So what we've seen over the last little while is, of course, the US dollar do really well, the euro do not so well. And in fact, the euro has generally been weakening on a macro scale for quite a long time. And you can ask, why is this, right? Well, the answer is that the main thing that you buy actually is debt, okay? So this basically means bonds. And if I'm in a situation where the European bonds are at zero or negative interest rates, the incentives for people to buy euros in order to buy those bonds is really low, right? So in other words, when you have a currency that has negative interest rates, it's probably not great for the currency. And of course, there's other factors, right? There's a whole economy there that's being supported by it. You're also in a situation where you have, for instance, kind of some degree of flight to safety as compared to with, for example, Turkish lira, right? Turkish lira devaluing super quickly, but that currency, the euro, has done, not particularly well relative to the US dollar. And this is pretty easy to see when you just think, okay, well, I could choose to put $1 billion into, I think you're like a big fund or, a company or whatever, into bonds somewhere. Here I can earn, 2%, and here I can earn negative 0.1%. Where am I going to go? I'm going to go here pretty much every time as a preservation of value. So what have we seen over the last little while? Well, the Fed is raising interest rates on the US dollar. Now we have a combination of factors, right? Because in general, the market is declining, and as the market is declining, people are selling assets. That basically is what it means, that it's going down. And what are they buying? They're buying basically dollars, right? So they're building up their cash reserves. And that's a factor that is certainly driving up the dollar in general. Now, accentuating that is the fact that the Fed is raising interest rates. So the European Central Bank is not raising interest rates. Maybe they will in the future, but at this point in time, they're really not. And so on a relative basis, this is increasing the strength of the US dollar. So this, I think, should give you some insights into where we're likely to go over the next little while. So some people are asking me, should I be buying euros? My opinion is probably you shouldn't. Now again, we've just had a big run up, so could there be a pullback? Yes, of course. But I think broadly, the dollar is likely to continue in a stronger market versus the euro. Doesn't mean versus any other particular currency, but versus the euro. And this is simply because of the fact that the US economy is at the moment quite a bit stronger than the EU economy, right? And as a result, the ability of the European Central Bank to raise interest rates is lower than the Fed's ability to raise interest rates. If you look at the job reports, they just came out yesterday or something like that, and the job market is still really strong, right? So that's one of the main indicators that the Fed is looking at, is what's happening with jobs, the labor market. So if they see high inflation plus strong jobs, that means they feel like they can amp on the interest rates. They can continue increasing. Their kind of expectation right now is 75 basis points for the next hike. Maybe we'll see what gets included beyond that. And so, we're at like 1.5% or something. So this would take us to 2.25%. We could see 3% interest rates by sometime in the mid-fall or whatever. So if you have 3% interest rates versus, say, 0% interest rates, it's just way more compelling, right? Way, way more compelling. And I don't see any real signs that the European economy is likely to strengthen relative to the US economy. I think this is pretty unlikely. I think it's pretty unlikely that the European Central Bank is going to be in a position where they can do a lot of rate hiking. And so I just don't see it as very likely that the attractiveness of the euro is going to go up quite a bit. So that's something I think is very worth noting. Now, the last part, though, is if you're going to buy a currency, okay, generally speaking, I think it's a bad idea to buy a currency. So I've seen this with friends who say they've got a lot of US dollars and they see, the Aussie dollar change and they say, should I buy it? Like, probably not, okay? Why not? Well, if you want to bet on the dollar, usually you're better off betting on solid dollar-denominated assets, or whatever currency it is, right? Whether it's Aussie dollar-denominated assets, or euro-denominated assets, or GBP-denominated assets, or Swiss franc, etc. Generally speaking, you're better off because it's a productive asset versus an unproductive asset. So the idea here is that if I'm buying something where the price of that asset is going to be, or sorry, not the price, the thing that I'm getting is just going to be stagnant, then I could be wrong on the timing, right? Who knows what goes on. So I'm taking on some timing risk, and I could even be taking on value risk if I'm wrong there. Whereas if I'm buying a productive asset, then at least I'm earning yield. The most basic productive asset you could buy was a bond, right? So instead of buying, Australian dollars, you buy Australian government bonds. That way they're paying you some interest, or Canadian government bonds, or Swiss government bonds, etc. Another example would be local real estate. Typically the real estate is local denominated. This isn't always true. For example, if you look at Turkish real estate, it tends to be US dollar denominated from the standpoint of the global market. But that's quite different from, say, Canada, if you were to buy in, say, Vancouver, it's priced in Canadian dollars. And so, if you're bullish on the Canadian dollar, you could go buy Canadian real estate. The Canadian real estate goes up, plus the currency goes up, and you get kind of a double benefit there. So that's just a little piece of advice. If you have any questions about it, put it in the comments below. Let me know what you think. If you have some other perspectives, I'd love to hear them. Love to hear your thoughts, and we can discuss them in the comments. I will look forward to seeing you on the next video.